Well, I think it's partly macro. You certainly got hit with Caterpillar, as you pointed out, and NVIDIA. But I think there's that backdrop. They shut down the shutdown, but they didn't do it very effectively, and it looks like it might erupt again in 3 weeks. So there's the usual amount of recent chaos in Washington, and I think that inhibits people from having any real faith in the rally, and that's why you're not seeing really big volume here. You did get protected. You bounced off the support in the area of 24,350 in the Dow Jones. That's held up pretty well. As I said last week and would repeat again, a close below 24,300 would put the whole rally from Christmas Eve into some question. Yeah.
So we'll watch the technical levels. Oliver, there are so many event risks this week. Earnings today, earnings this week. We've got a Fed meeting, including a news conference, which we're now going to get at every meeting. We've got China trade talks. And what's going to be most important?
Well, I think what will be interesting this week is the Fed meeting. Normally, January is relatively inconsequential, but this time we might hear them talk about the federal government shutdown and what the impact on the economy had. We heard earlier today out of the White House in the COB that it's $11 billion was the actual cost. We don't know whether that's the final number or not. Look, earnings, Brexit, China slowdown, very unlikely to get a trade pact by the end of February, March 1st, which is the deadline. So to Art's point, there's an overriding amount of questions with a backdrop of still a relatively strong U.S. economy. And that's the push and pull. I would also add that, we've rallied some 11, 12%, 13% at the high since the sell-off, today, before the sell-off today, since the December 26 open. So that's a pretty steep rally to go through in 4 weeks. So taking a little breath is not the worst thing.
So we were oversold and now we're overbought.
I wouldn't say that we're overbought, but nothing is linear, as we know. And so we think that, look, in the absence of a crisis, equity valuations are probably somewhere around fair right now. If things improve, they're still inexpensive, but if things deteriorate, then they become expensive, and that's where we are.
Rick, an extra press conference this week, of course, we'll be hearing from the Fed chair. Do you think that is more likely to yield a shock to markets or reassurance?
My guess is probably a little bit of the latter, but not much. I think all the reassurances and the moonwalking back of some of the more stiff components of a stenciled forward look by the Fed has been nullified. I really think that it's not that big of an issue, and I wouldn't suspect, after all the walking back that's been done, that they're going to carve out a new intensity with respect to the balance sheet or rising rates. And as for the closure, I always hate to disagree even a little bit with the sage Mr. Cashin, but truly, the people I talk to have not let the closure affect them or their trade or how it was resolved. What is affecting them is politics in general, and that's what's underscored by the way the partial closure opened up this new term of Congress. Let's all hearken back to November of 2016, before the president was sworn in. I still say, if you understand that rally, you understand a lot. It was the notion of a more business-friendly environment. Does the current environment of Democratic hopefuls for president sound business-friendly to anybody out there? No, I think that psychology is weighing on the market. I think the U.S. economy isn't doing bad, and I think anybody who expected more than Caterpillar was able to deliver was probably had their head in the clouds anyway.